it just doesn't work. It just does not work to have these kinds of home prices with 7% mortgage rates.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. After mind-boggling, ridiculous spikes, home prices in most markets are dropping. And in some markets, they're plunging at the fastest pace on record. And in some cases, they're going down faster than they'd spiked on the way up. And this is just the beginning. So says analyst Wolf Richter in his recent post, "The housing bubble has popped and the Fed can let it rip." Just how bad may things get from here? Well, we sit down with Wolf to find out. Wolf, thanks so much for joining us today.
Thanks for having me, Adam.
All right, Wolf, lots to talk about, and folks will be watching this video, I believe, the day after the national elections. So you and I are recording this the day before. We don't know what the outcome's going to be yet. If that's going to impact anything of what we talk about, just mention it as you see fit. But let's jump right in here. We're going to talk about housing today. What is your current assessment of the U.S. housing market?
You kind of quoted me there, and it is pretty tough out there. You know, we've had home prices spike by huge amounts in the last 2 years, and in some cities by 50 and 60% in a 2-year time span. And when mortgage rates were 3%, now mortgage rates are at over 7%. So the equation doesn't work out anymore. And the housing market is sort of reacting very rapidly to these much higher interest rates. And yeah, it just doesn't work. It just does not work to have these kinds of home prices with 7% mortgage rates. And they have to adjust, and the interest rates are not coming down. So it's going to be the house prices that have to come down to make this market work again.
All right. And you're talking specifically about mortgage rates there, which we'll talk a little bit more about in just a moment. And there's just that mathematical relationship between housing prices and mortgage rates, right? The higher the mortgage rate goes up, the less house you can afford, and therefore, or at least the less debt you can afford to take on to buy a house, and therefore home prices have to come down. There are other factors, I believe, contributing to housing prices as well. So hopefully we can kind of get into all of them going forward. But let's talk about the recent piece that you mentioned that I cited in the introduction. You say in that piece that, quote, "Raging inflation knocked out the Fed put, and banks are no longer on the hook for mortgages. Taxpayers and investors are." So can you expound on that a little bit and explain how that adds to the risk of a housing market price correction from here?
Yeah, so there's really two separate things you mentioned here. So one is the Fed put, and the Fed is now laser focused on inflation, and inflation is turning into a huge mess. And we had, I was on your show, or I don't know when, last year sometime, and we talked about it a little bit. And at that point, I said that 4% CPI inflation was baked in. You know, I was one of the radicals out there. And I completely underestimated where this would go. And now we're at 8%, and it's underlying inflation that's coming up. The Fed's been pointing it out. I've been saying it for many, many months. It's in services. That's 2/3 of the consumer economy. That's where inflation is now. It's no longer really in goods and commodities. So this has changed the equation. This was not transitory. This inflation has now spread across the economy. And services inflation is over 7% now, and it's just shooting straight up. And so the Fed acknowledged that, and it's focused on it. And, the last Fed meeting, at every Fed meeting, they get more hawkish. And they did so again in the last meeting. And they acknowledged that house prices are going down. And Powell essentially said, yeah, they need to go down. They have spiked so much that the housing market went completely crazy. Yeah, that can't go on. And so you've had this kind of dramatic surge in inflation, and the Fed acknowledging that is the number one problem, and acknowledging that home prices had gone wild. And so, when home prices go down, the Fed's not going to lower interest rates, not going to buy mortgage-backed securities, because it's focused on inflation. And this inflation isn't going away. I mean, it's going to get bad, and next year it's not going to be suddenly settling down. And so the Fed put is based on the ability of the Fed to jump into the markets with lower interest rates and maybe QE to support asset prices. And now the Fed cannot do that because it is focused on getting this inflation under control. And if the Fed tried to lower interest rates now and restart QE, we would really veer into hyperinflation. And the Fed cannot do that. So that's off. The Fed puts it is off, and asset prices have to find their own way. And markets are pretty good about figuring out how to do that. It gets a little rough sometimes, but generally, markets are good at figuring out what prices should be. And so now you have the other situation in that the Fed is no longer required to bail out the housing market because the banks are no longer on the hook, as you said. The banks have since the financial crisis sold most of their mortgages to entities that convert them into mortgage-backed securities, and the qualifying loans, they have been sold to Fannie Mae and Freddie Mac and all the other government-sponsored enterprises and government agencies. So they're taxpayer guaranteed, and the loans that didn't qualify for being bought by Fannie Mae and Freddie Mac, they were sold to private entities and converted to mortgage-backed securities. So we have these private label mortgage-backed securities. We have the government-backed mortgage-backed securities, and all of them are owned by investors. So they're owned by pension funds, they're owned by insurance companies, they're owned by bond funds, they're owned by global institutions. A bunch of them are owned by the Fed and maybe other central banks. So when these mortgages go back, and we're far from it. I mean, these mortgages are really good. We are just coming out in terms of the foreclosures and defaults. We're just coming up from the record low levels during the pandemic. So there really is not any kind of major issue on the horizon at this point, but there may be sometime in the future. And when that happens, it's investors and taxpayers that are going to be on the hook for this, and not the banks. The banks have very small mortgage exposure. I mean, they have some exposure because while they're waiting to accumulate enough mortgages to have them rolled into mortgage-backed securities, they're exposed to these mortgages. And some of the non-bank lenders do that, like Rocket Mortgage. They can get caught up in this, and they've lost a lot of money because of it. But in terms of being on the hook when credit goes bad, that's not the banks anymore. It's the taxpayer and its investors.
And I'm curious, does that increase or decrease? I mean, what impact does that have on the potential of or the unfolding of a housing price correction? In other words, if let's say the banks were as exposed as they were before, would there be more backstopping of the system because they're trying to protect the banking system? Like, in other words, can they just let the fire run more wild this time around because they don't have to worry about the banking system being taken down? Is it material in any way that banks aren't holding much mortgage debt this time?
Yeah, I mean, that was the reason they bought mortgage-backed securities and did QE last time. One of the reasons, because the banking system was collapsing under the strain of these mortgage-backed securities and mortgages that they were holding, and not really the mortgage-backed securities, but the mortgages. And it's not that the banks would have collapsed. It's that the investment banks had leveraged bets on this stuff, and like Lehman and others, and it's not necessarily that Wells Fargo would have collapsed or Bank of America or JP Morgan. It's that the big investment banks got in trouble with this stuff, and the other banks were just taking big losses, and we've had a situation where people started doubting in the health of the financial system, and so in a fiat financial system, you need confidence, and that's what it's based on. When you lose confidence in the financial system, then you can get all kinds of problems. And that's what we started to get during the financial crisis. That's what a financial crisis is all about, really, to some extent. it's a loss of confidence in the banking system. And so the Fed stepped in part to deal with that. And that's not an issue anymore. So the Fed doesn't have to do this anymore. And it won't be able to do it because there's too big of an inflation problem. And the banks will be just fine. You may have some of the non-banks, some of the shadow banks fold. They're already penny stocks, but they don't take deposits. So the problem with the banking system is that they take deposits. There's $17 trillion in the deposits in the banking system. So when the banking system gets in trouble, you're thinking about the deposits. But the shadow banks, they don't take deposits. They fund their mortgages in other ways. And so that's not really an issue for the Fed. The Fed doesn't regulate them anyway. I don't see any reason for the Fed to step in here. I mean, the Fed can let this correct and find the natural level where home prices should be, and the market will be fine. We've got lots of inflation and wages are going up. And so, I mean, there'll be a natural bottom somewhere in this house price decline.
Okay, so let's talk about finding the natural price for housing. But before we get there, let's talk about how housing got to the unnatural price state that it's at right now. So in your words, I think you used the word ridiculous to describe where house prices are right now in many markets across the US. Here is a quote from your piece. Over the past 20 years through early this year, home prices in expensive markets have tripled or quadrupled, according to the Case-Shiller Index. These markets include the metros of Miami, Tampa, Los Angeles, San Diego, Seattle, San Francisco, and others. What are the key contributors to this? And I'll start us off and you can build from there. One obviously is the Fed, right? It brought interest rates down to historic lows, right? And it also just provided lots of liquidity into the system. So it was easy to borrow, and it was easy to borrow at historically low rates. And when that happens, we talked about the seesaw relationship between cost of debt and home prices. Cost of debt goes down to historic levels. Well, no surprise that home prices went up to historic levels. Okay, so that's one. Anything to say else about that? And then what other contributing factors would you include?
You nailed that. Interest rates, mortgage rates are directly related to home prices. That has been well established over time. And in the normal range, it's not such a huge difference. When mortgage rates fluctuate with the rate of inflation, you have that. So you have high periods of high inflation, you're going to have high mortgage rates, and you have periods of low inflation, you're going to have lower mortgage rates. And that used to be the case before the Fed started really getting into interest rate repression. And so now we've had, 3% mortgage rates, below 3% mortgage rates. And for the last 2 years, and so that added another 50, 60% price increase on top of the already big price increases before. And, coming out of the dot-com bust in 2000, 2001, 2002, the Greenspan Fed, so the Fed led by Alan Greenspan back then, lowered interest rates because the stock market implosion was causing a downturn in consumption, and the tech bust especially, and a lot of jobs got decimated, high-paying jobs got decimated, and so to get out of that, the Fed back then decided to create a housing bubble to get over the dot-com bubble bust, and so we got the first surge in home price, unnatural surge in home price within a couple of years. Home prices just shot up, and that imploded when the Fed saw that and started raising interest rates. And so then we got the housing bust out of that. So then we do it all over again in 2008, 2009. It took housing 4 years after the Fed stepped in before it actually started going back up. I mean, it kept crashing despite QE and despite record low mortgage rates at that time. And so now we've got another and the most ridiculous spike ever. And and mortgage rates are higher than they were 20 years ago. And it doesn't take a genius to figure out where this is going. And yeah, that's just how it is.
Okay, so there are a couple other elements that I jotted down here in my notes. I'll just list them off, and if you want to opine on any of them, feel free. So we had the low interest rates, as we talked about. We had the fact that because of that, there was really no way to get a safe yield. So everybody was basically stretched for yield, right? Everybody was going out on the risk curve. And because real estate kept appreciating year after year, people began seeing it as kind of a sure bet, right? So more and more money sort of chased these home prices. And of course, investors got in because you could also get an actual real annual yield from the rents that if it was an investment property that was kicking off. So you had this push of capital that might have otherwise been in sort of bonds or safer investments that was now getting pushed out the risk curve. You also had FOMO. So sort of as I was mentioning, right, as these prices kept going up, that's you started seeing all the flip my house shows and stuff like that. And everybody began thinking either I better get in or I'm going to get priced out, or I'm going to buy multiple properties because everybody's doing it and it's so cheap to afford this debt now. You had boomers not selling, right? So everybody expected that boomers, as they reached retirement age, were going to start selling their primary residence and downsizing to a smaller house. In a lot of cases, they were doing that. They just weren't selling the larger house they lived in because they were looking at it like a stock in their portfolio because it was kept going up year after year. And maybe they'd rent it out in a long-term rental, or maybe they'd, Airbnb or VRBO it or whatever, right? So you had that. Then, of course, you had something very new this time around has been the percentage of institutional buyers in the market. Depending on what market you're talking about, on average, I've heard about like a quarter to a third of all single family houses have been bought by an investor over the past year. Certain markets I heard at times were over 50% in certain cases in 2021, just crazy. So you've got this new buyer who's got deep pockets, buys all cash, buys lots of houses in a particular geography. And then the last one was, and I know we've seen this a lot out here, you live in California or I do, there's a lot of capital from outside the US where wealthy people are taking their money out of their home country because they want to keep it somewhere safer than where their home country is. And they're pretty price insensitive because they just want to move their capital out. Like if they put it in a house and eventually that house loses 50% of its value, they don't really care because they think of that as, well, at least I got 50% of my capital out of my country, right? So here in California, a lot of Asian buyers. In the East Coast, there's a lot of Russian money, but that's been a factor too. So I'll pause there, but anything you want to say about any of those additional factors?
These are all good points. And let me just add a few things to the investors in the housing market. There were some smaller neighborhoods or parts of a market where investors were really strongly represented because an investor wants his houses to be close together when that's an issue. But a lot of the stuff which you saw in the media about investors, big funds, like BlackRock and so forth, and pension funds, what they were buying, they weren't buying individual houses. So they were buying whole developments of houses that were built to rent. So, and they bought them with tenants in them. And so they just changed investors, and they were sold by big landlords and home builders actually that had built these built to rent additions, put tenants in them. And when they had a certain fill rate, they sold them to big pension funds as a yield investment. And there's a lot of that going on last year and this year. And on Twitter and elsewhere, this got blown apart because people only read the headlines, BlackRock buys a whole neighborhood. And of course, that was total Twitter BS. What BlackRock did was buy a whole development from a property developer that had built that for rental purposes, had put tenants in them, and had sold the whole package to BlackRock. So there's a lot of this stuff about big investors going around that is also in part, I think, fueled by the real estate industry that wants to show that, yeah, there's some fundamentals here involved. Investors are really chasing after these houses, but that's not the case. The hottest trend in single family housing is built to rent. Yeah, that's absolutely the hottest trend. Yeah, there's a lot of rental demand for single family houses. And it's a lot easier to manage them when they're all in one place. When you got 500 houses all together, you have a rental office, and you have maintenance staff on there, and you can take care of these things. So this is really a big thing in real estate right now. And home builders are all over this. And they're building them, and they're advertising them, they're putting tenants in them, and then they're selling them to pension funds. And so I want to add this to it. And this is not taking a home off the market. This is creating a rental home, and they're competing rental homes and homeowner type homes. In a sense, they're competing on price with each other to some extent. And we're seeing that in really expensive housing markets. You get a lot of people that would rather rent, and it makes more sense financially to rent at some point. And these are nice houses that they're building. So this is something that is not much talked about, but it's the hottest trend in real estate, in housing, in among home builders and pension funds, is this built to rent thing. And in terms of the current investor portion of buying single family houses, it's way down. So we were down to about 15% according to National Association of Realtors. And for the nation overall, that's down from the 20% range earlier this year. And so, sure that in Atlanta, there may be some neighborhoods or some more in some places where you have a concentrated buying by an investor, but on a nationwide basis, that's really not the case. Investors do not like to buy at sky high prices. It doesn't make sense for them. They're professionals. They know they have to make money renting them out, and you can't make money if you pay too much. And so they have pulled back now too. I mean, they're not interested in this market anymore either. So yeah, I just want to add that to the investor scenario, which is a lot more complex than I think a lot of people believe.
All right, thanks for adding that nuance. I do want to earmark the last point you made there about them not buying as aggressively now because they don't want to buy into an overheated market, and a market that may actually now be correcting, because that's just one less marginal buyer at the table. Right. Okay, so I think we've set the stage here now. So let's get into the core of your recent article. And also, I need to mention too, that you have a regular series that you publish called The Most Splendid Housing Bubbles in America, with a lot of great charts on a lot of the largest housing metros out there. I think we're going to talk a lot about those in this conversation. So let's use mortgage prices as our jumping off point here. So mortgages are now at over 7%. I believe out here in California, they're closer to 8%. So what was it, August of 2021, I think the average 30-year fixed mortgage was 2.77, right? So we're on our way to a tripling here in like 15 months, right? That's pretty seismic in this market. And when we talk about math, tripling of the mortgage rate, that's got to have a very substantial downward drag on home prices. Clearly, prices are beginning to soften in a number of markets across the country, but it's just beginning to. We by no means, I don't think, have moved anywhere near the magnitude that just the simple math alone on mortgages suggests we should go. Just looking at mortgages, keeping everything else off the table for a moment, what kind of price correction would you expect on average, given how much mortgage rates have moved here?
Well, so, the issue is that sellers are not forced to sell at the prices that they could sell at, so they don't sell. And so you need to have some forced selling to get to the prices that make sense at these mortgage rates. And when you look at a payment that you could barely make with a 3% mortgage, the home prices were already inflated. So you get these inflated more, and then you finance it at 7 or 8%. You're looking at a payment that's up 50 or 60%. and you couldn't make the prior, you barely made the prior payment, so it you would have to, I mean, I don't even want to think about the price at which that would make sense. I mean, you would take a serious step down in price. I mean, 30, 40, 50% to make that work. And this takes years. And so I kind of mentioned that a little bit. It takes years to get there. And over these years, we'll have quite a bit of wage inflation. So that will help mitigate a little bit of that. And, you have, if you have 8% inflation, let's just guess, or 6% inflation for 4 years, that's a lot. And you have wage inflation that's just below that. So that's a lot. And then you have home prices that are coming down despite this inflation. So housing not being a hedge against inflation, but going down. At some point, there is an ability to pay for that house after it's dropped long enough with your inflated wage. And so that's when probably this housing bust will bottom out, is when wage inflation has come up enough and house prices have come down enough over the years to where, that house now can be bought with a 7 to 8% mortgage.
Okay. So correct me if I'm wrong here, but it sounds like you're saying just mathematically, home prices are going to have to come down pretty substantially. And you gave us a big range, and that depends on certain factors that you just mentioned there. It also sounds like you're saying this correction is going to take probably years to play out, like previous ones have. So it's not just going to be a watershed, bang, we hit the bottom, and then we pick ourselves up, the next month, and we're back off to the races. You don't see that happening. Sounds like one of the things that you think will play a role here in is going to be inflation, and particularly wage inflation. I don't want to rat hole on this, and I understand. Well, first I want to give you props, because yes, last time you were on the channel, which was, I don't know, 5-6 months ago, you were banging the drum that inflation was moving into services and it was going to be harder to control. And that has definitely played out since you made that statement. So I want to give you total kudos on that. I wonder, let me put it this way. If we have a really bad recession next year, let's put it on the scope of a 2008 or a 2001 style recession with lots of layoffs and stuff like that, right? Is there a chance that wage price inflation may not take off all that much? Because when you have lots of people losing their jobs, the worker doesn't have the bargaining power to demand higher wages.
Yeah, my scenario didn't include a heavy recession.
Okay.
I gave you the good scenario.
Give me the rosy version.
Yeah, where we can deal with this inflation without generating a huge recession. If we get a recession where unemployment doubles, we've got another 4 million people lose their jobs, and high-paying jobs, and some of them in tech, some of them somewhere else. That changes the equation entirely, because now you have forced selling. You have people that can no longer afford to pay their current mortgage because they lost their job. And when you have forced selling, it changes the dynamic of the market. And so prices are set at the margin. So they're looking at comparable sales, and they're looking at prices of what has sold in that neighborhood. And you have some homeowners that lost their job, and they lost their combined income of $300,000, and now they're on California unemployment insurance, and they cannot make that mortgage payment, that $10,000 mortgage payment. And so they're out of there, and in California, we are a no recourse state, so they can just send the house back to the mortgage-backed security holders. So the pension funds and bond funds, and let the taxpayer worry about that stuff, or the investors, and they're out of there, and they're going to rent. And the loss is going to be taken by the lenders or by the investors, and they're going to sell the home in a foreclosure sale, and that's kind of for selling, and that will have a much bigger impact on prices And if we get this kind of major employment crisis, or at least a major recession with a big uptick in unemployment, and especially in the Bay Area, if you lose a lot of these high-paying tech jobs, you're looking at a different scenario, and it could get pretty brutal if that plays out.
Okay. The question I'm going to ask you is what do you think is more likely, the rosy scenario or the recession job loss scenario? Before I do, though, I just want to have one quick discussion. So first off, you mentioned something that's really important. I've mentioned it on this channel before. I just want to make sure everybody gets it, that housing is priced at the margin. And that means the transactions that do happen in a housing market are what sets the market value for all of the homes in that market. So let's assume a cul-de-sac, there are 10 houses on it. They're all roughly identical, same style houses. And, nobody in that cul-de-sac wants to sell, right? They see the housing market softening. Nobody wants to sell. But eventually maybe one guy, gets into a distressed situation. He's lost his job, whatever. He decides he's got to sell. Let's say he sells his house and he's sold his house for 20% less than what the previous market value had been. Now the market value of each of the houses on that cul-de-sac has just decreased by 20% because that last sale, that guy's house sale, is the comp that all the rest are being set against. All right. So that's why understanding how real estate is priced at the margin is very important. Now, I totally get it, Wolf, that if we get into a recession, lots of job losses, et cetera, you're going to have a lot more distressed sellers in that scenario. But even if we don't, let's go to your rosy scenario for a second. There is some percentage of houses that have to move just organically, right? People die, they get divorced, they have to move, they might lose a job for non-recession reasons. So there's always going to be some volume that's happening, and that is going to be, setting the margin sale price for that environment. And even if we're not having, millions of folks losing their jobs, you're still going to have people that are having to sell a house into a market with 7% plus mortgage rates. So couldn't we even see a pretty substantial repricing anyways, just from that organic churn?
Yeah, and we're seeing it. I mean, what we're seeing is not just looked at the Bay Area numbers for October. We're seeing a very large number of sellers pulling their homes off the market after a fairly short time if they can't get anybody to look at them. So we see a very large number of active listings getting pulled because there is no traffic at those prices. And rather than letting it sit on the market, they're pulling. And then the homes that are on the market and they sell at much lower prices. So across the Bay Area, we're now year over year in the red. And at the same time, what we're seeing in San Francisco, it's quite a bit. I mean, year over year, we're down quite a bit. And what we're also seeing is a plunge in transactions, because sellers don't want to sell. The buyers don't want to buy at those prices that the sellers would be willing to sell. So you have this kind of standoff, as I call it. And in the Bay Area in October, sales volume was down 37% from a year ago. And in other markets, it's similar. This is a huge drop in volume, and it's getting worse. This is the worst we've had, and it, I don't see it getting any better. The thing is, you have this standoff. So sellers are not accepting the reality of where buyers are. Buyers are still there. They're still out there, but they're a lot lower. And the sellers do not want to come down with where the buyers are. So the transactions that don't have to take place, they don't take place.
Right. But this is the progression you expect to see in a softening housing market, right?
Right.
Where initially you have the sellers that are just denying reality, right? Hey, if the listings aren't selling at the price we want, we take them off. Maybe we can outweight this thing. Maybe the market's going to come back, right? They're just sort of hoping against hope here. And the buyers are saying, yeah, there's just no way I'm going to buy at those prices, right? And then eventually something breaks. And I think you've written about this, and I've talked about it too, where when enough people begin to wake up to the fact that, okay, this is a downtrend that's about to start here, there's a real first mover advantage, right? If I break from the herd early, okay, then I can sell my house for only 5 or 10% below market value, right? And I'll get 90+% of my value. Where if I wait, I'm going to be one of those guys who's riding this thing down potentially, right?
Yeah. Right. And we see that, in the Bay Area, particularly what I'm looking at now more closely, people that sold in the summer and before, while everybody was still in denial, they got very close to peak value. Yeah, it's already coming down, but and they had to come down lower to sell, and it worked, and they got out. And now they're chasing it down, so they're chasing the prices lower, and so they pull it off the market. They don't have to sell, and we've got this whole pivot idea. The Fed's going to pivot. I've heard this now since May. The Fed's going to pivot next month because it will never ever allow this to happen. And so now the homeowners are believing in this Fed pivot that will come any moment now, and that mortgage rates are going to come back down, and then we'll sell. And that's just not going to happen. And so the FOMO attitude was there before, and now it's this attitude of, if you can just hang in there for a little while, the Fed's going to pivot, and then we can sell. And this is really an astonishing thing. And I see this on an anecdotal basis. People saying, well, I'm just going to wait till mortgage rates come back down, and they'll come back down next year, and then I'll sell. I can afford to hang on to this house until then. And maybe I'll put it on the rental market. And of course, the rental market is starting to look weaker too. And so, I don't, the standoff just is not getting charred loose yet. The volume continues to drop, and the standoff is just, it's clinging to the pivot hopes right now. And it's not until the pivot hopes disappear that the standoff will disappear, and people say, okay, this is serious. We're not going to get lower mortgage rates. If you want to sell now, we better sell if you want to sell, and we don't want to hang on to this much longer. It's the carrying costs of a house are big. You don't want to, a vacant home is expensive to carry. And so if prices don't go up, if prices go down, eventually you're better off, and people know that, you're better off selling the home at a mild loss rather than, paying the expenditure for carrying that vacant home. Now, there's another thing, and I want to point that out. Like, even in the cities where home prices have spiked by the most, like in Miami and Tampa, and by 60% in 2 years. So when prices come down about 30%, they're just back where they were 2 years ago. So there's only a small number of people that bought homes during that spike, and especially during that peak of that spike. So there are really not that many people that lose a lot of money. So the numbers are pretty small. And the Fed knows that too, and everybody knows this. The number of people who bought homes in the last 2 years is not huge. It's a pretty small number. And the ones that bought during the peak 12 months, they're underwater seriously, and they will be underwater further. And, but that's a small number. So, the others that bought 2 years before and before that, they can just live in the home and make the payments and be fine. They don't really, they're not looking at a loss at this point. Now, home prices come down 40 and 50%, they're starting to look at a loss. But home prices have risen so fast that even if they come down 40 or 50%, they only go back a few years. So it's really not such a big economic damage if that happens, because home prices have just spiked so much that there weren't a lot of transactions going on during that time when they spiked.
So let me just pull on a few of those things. So I read that most of the houses that sold pre-2020 sold to millennials. And it's something that like 70% of them, just reading this morning, 70% of them have buyer's remorse. Like, I never should, I really regret buying, right? I've realized being a homeowner is expensive and it comes with a lot of hassles, but also I'm looking at the value of my house drop here and I'm freaking out, right? That's not good from a societal standpoint because we're kind of kicking our younger generation in the teeth yet again, because these kids, in most cases, had to stretch crazily to get into the houses at these ridiculously inflated home prices, right? Mm-hmm. So it's like adding insult to injury there. But also, well, pre-2020, we could have made an argument that housing prices were still pretty crazy, right? Looking at your charts on your splendid housing bubble page there, most markets were above their 2007 heights in 2020, right? I mean, and notably above them, right? So they clearly were already in what you could argue was bubble territory back then, right? The other issue is yeah, let's say we dial back to 2019 prices or something like that in houses. Yeah, there are some people that they bought their homes back in 2013 or 14, and they're fine to a certain extent. But there's the psychological negative wealth effect of that person saying, okay, I was used to my house being worth this incredibly inflated number, and now I feel like I have lost 30+% of that. And so I'm going to crimp my spending, right? And that impacts consumer spending, which then, contributes to the recessionary factors of companies having to lay people off and stuff like that, right? Also, you have the additional issue of, a lot of the people who are sitting pretty in homes like that are boomers. And for a lot of them, they look at their home equity as their retirement, right? So now they are in danger of whatever they've been valuing it at as of this year. They're now looking at a threat to like, oh, my retirement savings might be about to get cut in 20 or 30%, right? So yes, technically, we go back to 2019 prices. Yeah, they're not that bad from what they paid for the house, but they may be relatively quite bad from where they felt they needed to be. Does that make sense?
Yeah, and the psychological impact is hard to measure. What we can see is that people, when in a market where home prices are spiking, they're refinancing the mortgages and with cash out mortgages. So they're drawing cash out of their homes and they're spending that money. And so you can't really.
Wait, real quick though, they were, right? I mean, aren't like refinancing's dead now?
Yeah. So they were doing that. And so we had this huge, as mortgage prices plunged during the past prior 2 years. And even in the prior 10 years before that, people refinanced the mortgages and took $30,000, $50,000, $100,000 in cash out. So actually got a bigger mortgage and got a big pile of cash that they then spent on different things. And that could buy a car with it, or they could pay for college, or they could remodel their home, or just blow it on gambling or whatever. Yeah. And, a lot of people put in the stock market and cryptos and other things. Yeah. And so you have that, you have that cash out refis contribute to some extent to consumer spending, and they also contribute to other asset prices. So that has gone away essentially. There's still some cash out refis, but they're really very small now. And overall refis, of course, have collapsed completely. And so that's really the financial impact. I mean, there's a psychological impact that you're talking about, but there's a hard financial impact in that using the home as an ATM sort of disappears. And but it's not that big of an impact. When the Fed repressed interest rates starting in the financial crisis, the people that were relatively close to retirement or in retirement had a lot of their money in yield investments, so bonds and CDs and bond funds and different things. And so when they had to replace the 5% bonds and 5% CDs, they got almost nothing from the new thing. And whatever they ended up buying, they got 0.25% or 0.5%
right
on their CDs, and they got 1 or 2% on their bonds or whatever. Unless they went way out on the risk curve, their cash income that they relied on for retirement disappeared. And I've long said that this has hit consumer spending very hard because retirees spend every dime they get in cash income out of these fixed income investments. And that ended. And, so you have this trillions, many trillions of dollars invested in fixed income that suddenly don't contribute to the cash flow of these people. And then they cut back the spending, and they did that. And that's why consumer spending was a very lousy recovery after the financial crisis, because a relatively big part of the population got the cash flow cut. And that was a much bigger impact, I think, than the using the home as an ATM, because it's a much smaller number of people that actually did that, even though the amounts are larger. When you do it, you get a bigger amount of money, but a lot of that didn't go into consumer spending. Some of it went into investment. So they took it out of the home and put it in stocks. That doesn't do anything for the economy, or put it in cryptos. That does zero for the economy. So we had those two things, and now we get a lot more cash flow to these people. So there's $17 trillion in deposits in banks, in CDs and savings accounts, all kinds of things. There are many more trillions than that in fixed income products that are now starting to generate a bigger return. That's cash flow that's going to these people. They're going to spend it. And I see it in my comments. I see it all around. People are starting to make money on their fixed income investments in terms of cash flow. And, that's a good thing for the economy. So we forget, when we talk about home prices, we forget who paid the price for that. The price was paid by fixed income investors. That got crushed. And when the home buyers and the investors got bailed out by the Fed in 2008, 2009, in those years, the fixed income investors got crushed, those that were relying on the cash flow. And that pendulum has now swung back, so now the fixed income investors are getting their cash flow, and the homeowners are getting crushed in terms of the ATM, using the home as an ATM. And that's a big factor, so I don't think we're going to get a huge consumer recession because of that, because now we have this part of the population that's getting cash flow that didn't have before.
All right, interesting. So to a certain extent, it is sort of Fed to the rescue in the sense that it's raising yields across the board. Of course, more on the short end of the curve, but people finally have a way to get a dependable return on their financial capital.
Yeah, you can buy a 10-year Treasury security today and get 4.2%. You get crushed by inflation, but you get 4.2% for the next 10 years.
Yeah.
And people are going to spend every dime of that 4.2%. It pays every 6 months, and they're going to spend it when it comes. So this is the counterbalance to using the home as an ATM when mortgage rates drop. You've got this other thing, this big pile of fixed income money that's sitting over here. That's getting its cash flow cut. So I don't know what the overall balance will be now, since we're so new into this, so, your fixed income investment has to mature, and you have to replace it before you get the new cash flow. So it's not instant,
right.
It works gradual.
There's a hypothesis I've heard, I'd love to get your feedback on, which is, a lot of housing inventory, as we talked about, is owned by investors. There's still a lot of mom and pop investors out there that used to be primarily mom and pop investors, right? People that had a couple of housing units. And being a landlord, there's the hassle that comes along with it, right? There's risk and hassle. And while, again, debt was so cheap, it was super easy to get into properties that cash flowed, and you made enough money that it kind of flooded over the hassle factor, right? But now that the gravy train is over, prices aren't appreciating the way they were. In fact, they're coming down, and now cost of debt's a lot higher. The thesis is that, hey, you might get a lot of, on the margin, you might get a lot of people who otherwise would have continued to invest in real estate saying, it's just a lot easier if I just park this in a 10-year Treasury and I get my 4+% and that's my cash flow. I don't have to worry about the hassles and the risks of being a landlord, which of course would then steal capital going into the housing market. What do you think about that?
Yeah, I think that some people are thinking in those terms. I mean, it's a completely different investment. Yeah, buying a 10-year treasury in some sense is the most conservative thing you can do, and there's essentially zero credit risk. You have the risk that, and it's, if you buy an auction, hold to maturity. That's what I'm thinking about. If you try to buy and sell in the market, you run into other problems. But if you buy at auction, hold to maturity, you're going to get your $1,000 back at the end, and you collect interest along the way, and you don't worry about anything. And yeah, if you're a landlord, that's a job. You're an investor, an active investor, and you got a job to do, and you have lots of risks. And
you get calls in the middle of the night. You get
exactly
contractors that need babysitting. You
got bad tenants, or the possibility of bad tenants. I mean, everybody dreams of the good tenants, and they're great when you have them, but you don't always have them. So this is an entirely different investment. The yield should be far higher than on a 10-year treasury, because you're taking risk and it's a job. And you may have to pay people. So, I mean, if you're an absentee landlord, you have to pay somebody to take care of the house. And, so I cannot imagine somebody thinking, okay, 5% yield on a rental property makes sense when the 10-year treasury yield is close to 5%, and it's a completely different thing, and it wouldn't even be the same person. If you want to be a landlord, that's a different thing than holding treasury securities. I don't really put them in the same category. So but I do think that real estate yields are being impacted by treasury yields, and that's generally the case. Which means that prices are having to come down to make these yields work. And so if you have a 5% 10-year treasury yield, you might want to have a 7 or 8% yield on your rental property or more, to make that work. And that means the price has to come down when you buy it.
Right. Okay. Well, look, let's get to the real stake part of the discussion here, which is, which markets do you think are the most vulnerable heading into this period of instability that we're talking about here? Feel free to talk to any markets on your splendid housings report, and we'll throw up the charts here. And I will say, looking at a number of these, you can see that a number of them have they have peaked, and they are beginning to come down. And that's very notable, because you can see that they've pretty much been in an uninterrupted ascent coming out of, the great financial crisis. So from like 2012 to now, they're just pretty much been on an elevator up. If you consider the 2007 peak a bubble extreme, we are so far above that in most of these markets right now, which is why I'm sure you use the word ridiculous when you talk about today's housing prices. But when I look at a lot of these, I feel like, okay, this is showing that the direction of change has changed. And given these elevated levels, it's like hey, look out below type of visual we're getting here.
Yeah, and so one caution here: the data I use for the splendid housing bubbles is from the Case-Shiller index. The Case-Shiller index, the way it's structured, is a 3-month moving average. So the figure for September is the 3-month moving average into August. So we are looking June, July, August. And those are the deals that were recorded in public records. So they closed before then. And so we're looking at a 4 to 6 month delay here.
Okay. So you're saying that if these trends have continued, things are likely a lot worse than what these charts are suggesting.
So we can see that in the median prices now that are coming out. I don't like median prices because they're subject to so many distortions, but they're reacting much more quickly, and they have come down a lot. And so we're not there yet in terms of the Case-Shiller. So we've just seen, as you mentioned, kind of the beginning of the first 3 or 4 months in those housing markets. So that reflects through the summer. And we haven't really seen, or into the summer. We really, in the data there, we really haven't seen what's happening now. And what's happening now is that there's no volume. The deals that are being made are the deals that have to be made, and where sellers are motivated to sell. And there's some, you price a home right. It's always the case. If you're a seller and you put the right price on it, it's a good home, you can sell it, no problem. You might not get what you want. So it's not like nobody's selling anything. It's just, you have to price it right, and you'll find a buyer, and the buyers are lower. So that's what I want to say about this Case-Shiller index. We're looking backwards. We're looking 4 to 6 months back as in terms of what happened on the ground back then. And so when I talk about in that article about the 3 to 4 months, 2 to 4 months time period of dropping sharply, that's way behind us. Now we've got a much bigger issue. And let me say something else here. I started this the Most Splendid Housing Bubble series in 2017 to document the crazy price increases we had back then.
So half a decade ago.
Half a decade ago, yeah. And then you have the bubble and you have the bust. And I wasn't calling it the housing bust. I was calling it the housing bubble. And to document visually the craziness that's going on in this market back then in 2017, 2018. We're already seeing it. And so now it's a little bit cynical almost, because you can see the spike going up and coming down, so I'm going to keep the name. I'm not going to change it, but there's now a cynical quality to that name, the Most Splendid Housing Bubbles in America, that I didn't originally intend to be there.
Well, okay, so let's name some names here. Let's put some charts up on the screen so folks can really see what we're talking about. What markets are worth talking about here?
Yeah, so the San Francisco market is the one. So San Francisco Bay Area. So for the Case-Shiller, that's a 5-county area that includes San Francisco and part of Silicon Valley and part of the East Bay and a little bit of the North Bay. And so that's the one that has dropped probably ahead of some of the others. Seattle so the Seattle Metro has plunged a whole bunch. And then you see other markets falling a little bit behind, and even in Florida now, where there hasn't been any slowdown at all, we see the first drops, and they had the biggest spikes down there. So I expect over the next year or so to see some of the biggest plunges, because prices were just really going out of whack there in the Tampa and the Miami area. And so, what we saw from the last real estate, but these local markets have a life of their own. And last time, the San Francisco Bay Area, San Francisco in particular, was really late in blooming. It peaked in 2007 or 2000, about 2007, while other markets had already been dropping for 2 years. And so there was a local saying back then that San Francisco would be spared the downturn. And then, of course, it hit pretty hard, and San Francisco caught up very quickly. So you have this situation where now San Francisco and Seattle, among those 20 cities in the Case-Shiller Index, are leaders, but there are many other cities in the United States that are not captured by the Case-Shiller, that have seen, like Boise and others, that have seen big drawdowns. And so I don't want to say that San Francisco has a steeper plunge in the nation. It's just among the 20 cities in the Case-Shiller, 20 markets in the Case-Shiller, it has San Francisco and Seattle have the steepest plunges, but not across the nation. And there are some real problematic markets out there now.
Okay. Do you want to name one or two? I'm guessing Phoenix is probably one of them. Maybe so Austin.
Phoenix is in the Case-Shiller, so we've got that documented there, and we're seeing it. In Las Vegas is in the Case-Shiller. They're having a real problem now. What's not in the Case-Shiller are some of the other boom markets, like Austin is not in it, and in Texas doesn't disclose home prices publicly. So those the Case-Shiller people back then, when they instituted the index, had to make a special deal with the Dallas realtors to get the data. So they're Texas has some of the biggest housing markets in the country, including Houston, and it's not in the index, so we don't really know. But I know in Austin, Austin's getting hit, and Boise's getting hit, and there's a bunch of other markets are getting hit. So all the tech markets that you're seeing. And so there's other issue. We're talking about mortgage rates, but the stock market decline and the crypto decline is really important. And in some of the tech areas, like the Bay Area, especially San Francisco, Silicon Valley, these people have gotten their rug pulled out underneath them. And so everything they have is invested in these instruments in stocks and cryptos and housing, And so, so here in the Bay Area, there's a big correlation between stock prices, the NASDAQ especially, and home prices. And that's unrelated to mortgage rates, So,
right. And sorry to interrupt you, but let's pull on that real quick. So back to the question I was going to ask you about, what do you think is more likely, your rosy scenario or the more painful one? And here in San Francisco, you just mentioned, the correlation to NASDAQ. So we're having one of the worst years ever for both stocks and bonds. NASDAQ is definitely the major indice that's getting hit the most. The big generals, the FANG companies, were the ones that were hanging in there for the longest, but now they're beginning to stumble. The week you and I are talking, Twitter is in the process of firing half its staff. Meta just came out and said, we're going to be doing big layoffs. I can go through a number of companies I've been putting up on my Twitter feed for weeks now. There's just the layoffs are beginning to happen at scale now. So anyways, what do you think? What's more likely here?
Well, I don't think there's a rosy scenario here in San Francisco. This is a very wealthy, expensive place. So people have been here for a long time. They're going to sit this out. But people who arrived recently and they lose their jobs, they can't afford to live here without a job. And so they leave. And when they did during the dot-com bust, they left, and the place empties out, and you've got housing stock on the market, rentals and for sale, and now we've got this, which we didn't have before. We've got this huge problem with the empty offices, and nobody knows what to do with them, and Facebook has a whole tower in San Francisco that's empty, and what are they going to do with it? And that's everywhere now. So there's going to be some major adjustments to be made here, and it's not necessarily a rosy scenario, I don't think, here, but nationwide it's a little different. And still we're talking about all these layoffs, but there is still a lot of tech talent being hired and surged by other companies that couldn't get them. All the automakers are trying to hire like crazy for the EV divisions, and they're hiring coders and they're hiring engineers and they're hiring all these people. They're hiring AI people, they had trouble getting them because the tech companies were swallowing them all up. So now they're becoming available. So somebody who worked for a startup or something that's going out of business, they may get a job at Ford. And so, I don't think overall, and that's what we've seen in the numbers, in the layoffs overall nationwide, this relatively small number of tech layoffs really haven't registered because, 1.3 million people get laid off every month in the United States during the best of months, and 12 million people get laid off during the worst of months. So when you get 200 or 300 or 3,000 people added, it just doesn't really show up. But also, in terms of unemployment compensation, these people are not laid off for very long. They don't even have enough time to file for unemployment. They have another job already. And we've seen that unemployment applications, so unemployment insurance applications are near record lows. Every week that data comes out, it's just astounding how low it is. We're not seeing these numbers come up enough yet. And so
we have seen them bottom, right? They are creeping up now. They're not
just a tiny little bit. Last week they went down again, and they're just near historic lows. Now we're looking at the low 200,000s. They need to be about the 300,000 level to where we see that the labor market is actually weakening. We just haven't seen that, and that's weekly data. That is pretty real-time data. unlike some of the other labor data we see that is really far behind. Like the job openings data that we're looking at, the last batch, that was for a month a while ago, so we don't really know how many of these job openings are still open. Yeah, but we know that Ford has been looking, GM and all these car companies have been looking for tech employees. They couldn't get them. Now they can get them. And so that means that people who worked in the Bay Area maybe won't work in the Bay Area anymore. They go where the job is, and going back to housing, they get a great job. It's one of the automakers or one of the other industrial companies, and and they leave, and they take the money with them, and they're going to put their home on the market, or they just leave the rental behind, and they're gone, and that's happening. That's why locally, I think we may not have the rosy scenario, but nationwide, it still looks like a rosy scenario. So far, I've been looking at these layoffs, and I've been expecting these unemployment claims to come up, and they really haven't. And to go up a little bit, and then the next week they go back down. And it's just astounding how these people get absorbed by companies that have had labor shortages, and they're not picking them up, so we'll see. If Facebook lays off 5,000 people, it's global. Like Twitter laid off 3,500 globally, and has decimated its staff in India by 90%. So some of them somewhere else, and it's not all here. So but the numbers are just, the unemployment claims numbers are just not yet showing these layoffs. And people are getting laid off, but if they have a job lined up, they're not filing for unemployment compensation. That's right. I think that's the scenario we're still looking at. And,
it sounds like a lot then depends on what's sort of going to happen nationally in the economy.
Here's the thing, during and I looked up the numbers back because we really had a problem during the unemployment crisis in 2008, 2009, and into 2010. Big companies were laying off 10, 20, and 30,000 people at a time.
Right.
These are the numbers, 10, 20, 30,000 people. So the big companies that everybody knows about, so they've changed now. It would be Google, Apple, and different companies. Back then, it was GM, and it was Hewlett Packard, and it was those kinds of companies, and they decimated their staff by huge numbers. And that's when we got the unemployment crisis. We didn't get it because some companies laid off 700 people and others laid off 3,000. We got it because they were laying off huge numbers of people all the time.
Right. So presumably, if we were to get to that stage, you would obviously be more pessimistic about
hugely. Right. If that happens.
And I just want to flag. No one knows what's going to happen. I just want to flag that. Companies are slow to hire, slow to fire. Right. Meaning those big layoff waves you don't get until the companies are really struggling. Right. So we could potentially get to a point in 2023 where the rest of corporate America gets to a point where they're like, look, we got to start shedding en masse. Not saying it's going to happen, but I'm just saying, you wouldn't expect those companies to be at the forefront of dumping people at the beginning of a recession. You'd wait until they really had no other choice but to do so.
Yeah, but they used to be pretty aggressive, especially Hewlett Packard and others, as soon as, because stock price will jump. They announce a big layoff and the stock will go up. And so now we've been through a labor shortage because the labor market has completely changed, and it's contorted, it's screwed up, and these companies now know that if they lay off 10,000 people, they may never be able to hire them back. And that happened after the pandemic.
Right. Which is why they don't want to do it unless they've got a gun to the head.
Yeah, but that's new, so now they realize, or during the pandemic, we laid off all these people, and we still can't hire them back. We've tried now for a year to hire them back. We still can't hire them back. And the companies that did not lay off, they came out of the pandemic in much better shape. So they're looking at the airlines, for example. The airlines got $50 billion in government money to not lay off people. And, that's the whole scandal about the airlines. They got $50 billion to not lay off people, and they used the $50 billion to offer buyouts to their employees.
Right.
And a lot of them took the buyouts, $50 billion gone. Then air travel takes back off again. Now the airlines are short-staffed and cannot rehire pilots. A pilot shortage, staff shortage on the ground, shortages everywhere, chaos out there in airports. Over the summer it was completely a fiasco. And why self-inflicted? Because the airlines took that money, that $50 billion, to get rid of their employees rather than to maintain their staff and have them. And some airlines came out better because they didn't really get rid of that many employees. Had they maintained their staff, they would have been much better shape handling the reopening of the travel season. And so everybody saw that. And if I were a big company CEO, I would think, okay, a recession is going to last 2 quarters. Unless we have a big fiasco, it's going to be fairly mild. Our revenues are going to go down, or maybe they just won't even go down. They just stop growing for a couple of quarters. Stocks going to go down a little bit, but we're going to carry our employees. We're going to get more efficient. We're going to do things better. We're going to relook at things, but we're not going to do mass layoffs because 2 quarters from now, we have to hire these people back. And then we start over again with these problems. And I think you will see that now Facebook is a company that has a real problem, a real company problem. That's a unique Facebook, a new Meta problem. And Google doesn't have that problem, and Apple doesn't have it, and Amazon's got a different problem, but doesn't have the Meta problem. And so, the Twitter layoffs, Twitter got bought out by Musk. So these are all unique situations, and we haven't seen the mass layoffs in response to a recession yet. I just don't see that. We see some specific company-specific issues, and a lot of these money-losing companies like Lyft and Uber and all the biotechs that are collapsing and all this stuff, little companies that never made any money. All this stuff, that will go away. These companies will, companies that can't make any money forever, can't stick around, and they will eventually shut down. So we'll go through that process, so that will create some unemployment, I think. But the numbers are not huge.
Okay, all right. Well, I got to move on here in the interest of time. 2 last quick questions for you. I'm going to have to take quick answers, and we're just going to have to go more deeply into them the next time we have you on. One is we get through whatever housing correction is ahead of us here. Do you see us as, once we're through, going back to the way things have been for the past, 10, 15 years? Or is the era of sort of housing speculation permanently impaired here?
Well, it depends on inflation, and I don't see the Fed cracking down Volcker style enough to get inflation down to 2%. I think it will be higher going forward. I mean, it'll come down eventually, hopefully from where it is now in a few years, but I don't think it will go back to 2% easily. And so you have high inflation, which means you have higher mortgage rates, and you have an inability of the Fed to support asset prices because they're still worried about inflation. And so I think that's my long-term scenario. The era of QE, I think, is over. And at least for a long time, And I mean, if something huge blows up, they might do QE, but the Fed now has the repo facilities, so it can briefly support liquidity in the markets with the repos. And that's not QE. I mean, I can jump in a day and solve a panic and be out of there in a week or two, and that's different than systematically buying bonds. So I don't think that this era that we've had since 2008 will return. Not for a long time. I think we're looking at higher inflation and higher mortgage rates for many years to come.
Okay. I talked to journalist Pedro da Costa, who's covered the Fed for decades for publications like Reuters and Wall Street Journal. And he says, he talks to the Fed policymakers all day long. He concurs with you. He thinks that QE as a stimulative tool is going to be put away for good. And yeah, there'll be these facilities that will provide emergency overnight lending and whatnot in a time of real crisis. but we're not going to see QA the way that we've seen it over the past decade. And folks, if you want to learn more about that, I'll put up a link to that interview here. You might want to watch it after this one. All right, so Wolf, real quick, and I mean real quick because we don't have much time here. Any particular sort of parting advice to either existing or aspiring homeowners or renters at this point in time about the current housing market? I'm going to guess in general, your point is going to be, at least for aspiring homeowners, probably patience is your best asset here. But if you're an existing homeowner, I guess anything in particular you'd tell people to consider here?
I think it's back to basics, enjoy your home, be happy, make your mortgage payments, and don't look at Zillow. Just forget about it, and just use your home what it's intended to be used for, and it's fine, you don't, if you stop looking at Zillow, you'll be fine. Just make your mortgage payments.
Okay. So don't lose your income. All right. And I'm sure there's going to be a ton of questions here for you, Wolf, that we didn't get a chance to get into. So we're just going to have you on here again. For folks that have really enjoyed this conversation, maybe meeting you for the first time in this interview, where can they go to follow you and your work and learn more about you?
wolfstreet.com. That's my platform. Everything is free. There's no paywall. We don't sell anything. It's just business, finance, and money. And wolfstreet.com. And we have a relatively well-behaved comment section with lots of comments. And so check us out.
Okay, great. All right. Well, Wolf, thanks. It's been phenomenal. Folks, if you've enjoyed watching, would like to see Wolf back on the program and just other great speakers like him on this program, please support this channel by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. And, if you are a homeowner who's wrestling with a decision to sell, or you're an aspiring buyer wrestling with, how you should time the buy, if you would like the input of a financial advisor who understands all the big macro housing issues that Wolf and I talked about here, as well as just the total macro environment that housing is having to play in these days, consider talking to one of the recommended financial advisors that Wealthion endorses. It's a free conversation. It's a no commitment experience, no expectation to work with them. They'll just sit down with you. They'll hear your personal story. They'll tell you what they think you should do. They offer it as a public service. If you're interested in setting one of those up, just go to wealthion.com. All right, Wolf, again, just another phenomenal conversation. Thanks so much for taking the time to join us today. Everybody else, thanks so much for watching.